duration of higher interest rates maintained by the Federal Reserve, defined as the time between the previous rate hike and the first rate cut. Now we're over average, as you can see. The previous three occurrences, which occurred while we were at a greater level than we are now, served as precursors to the global financial crisis of 2008. We ended up with 0607. It foreshadowed the AT and telecom crash of 1997 to 1998. Recessions in 1969 and 1970 were heralded by it. The issue rate of Bitcoin is cut in half at each halving event, which keeps the inflation rate of the cryptocurrency stable until the following halving year, claims Cathie Wood. There is a polar opposite with the monetary policies of national governments. Monetary policymakers inflate the money supply to nearly irreparable levels during monetary easing and do the same or much more damage during monetary tightening. According to Cathie, the U.S. Federal Reserve is currently engaging in precisely this. To combat inflation, the central bank has pledged to maintain higher interest rates for the foreseeable future. This, according to Cathie, is a monumental error that will further destabilize the economy and the markets. If we do not act quickly, the CEO of ARK Invest thinks another major global financial disaster will befall us. As Yassine mentioned, this halve chart demonstrates the mathematical discipline. A Bitcoin brainstorming session was held with miners. Also, Yassine is going to set that up shortly, in my opinion. Still, all it took to write this monetary policy was 5 lines of code. Prior to our Bitcoin brainstorm, I was unaware of that. Everything about it is exquisitely understated and uncomplicated. Now compare this to what we have here. Finally, here we have M2 growth, shown as a percentage change over the past 4 years. What was the yearly rate of monetary growth from March of this year to March of last year? Or from March of this year to March 4 years ago? You can see the black dash line, which is the last data point here. Here we have a rate of approximately 8%. Actually, I'd be surprised if it wasn't closer to 6%. You may see a mountain of information on this graph. Look at the M2 growth rate over the past 4 years, though. It is dispersed, as you can see. It clearly approached double digits in the 1960s and 1970s. Inflation reached double digits in the late 1970s and early 1980s. It seemed to be really sticky and took quite a bit to get there. Next, about 1979 or so, Chairman Volcker entered the picture. Following his statement, he began squeezing the money supply in an effort to bring the situation under control. Even into the mid-1990s, that trend persisted. After that, the mid-1990s are fascinating because they mirror our modern day to a certain extent. There was a chain reaction of devaluations of currencies all around the globe in the mid-1990s, since our currency serves as a global reserve asset. Our monetary policy has been making its way around the globe. It was Mexico that experienced the first depreciation, plus it was a major one. We were dealing with Mexican stocks, so I remember it perfectly. Then the Asian domino effect happened a few years afterwards. The Thai baht probably lost some of its value in 1997. After that, the value of most Asian currencies fell. After the Russian default in 1998, long-term capital began to crumble. Unpredictability in monetary policy has a domino effect on the system and can cause many forms of excess. What we have here is a picture of what transpired as a result of COVID, which caused the 4-year annualized rise in M2 to reach 12% before rapidly slowing down. We threw money at the system to avoid a full-blown depression, in contrast to the 1960s and 1970s when there was a tendency toward acceleration and stabilization at double digits. If we can achieve a year-over-year growth rate of about 0% by the end of the year, this line will fall toward the 2% to 3% range, which has only happened once before. All hell broke loose in the globe following that in the 1990s, has further destabilized economies that were already in a fragile state. Against the dollar, at least 3 other currencies have fallen in value by 40 to 60% in the last year. The good news is that anyone in any of these nations who has access to the internet may simply get insurance using Bitcoin. To put it another way, this has assisted countless people in developing nations whose fiat currencies have been steadily depreciating. Furthermore, even industrialized economies are starting to exhibit warning signals. On top of that, Cathie thinks things are just going to get worse from here. Additional video snippets can be found here. Global monetary instability has put us in a very intriguing situation. Since everyone in emerging markets has access to the internet these days, I frequently discuss these devaluations with Yassine. I theoretically set up or purchase a Bitcoin insurance policy, which, when compared to the erratic behavior of monetary policies in the US and elsewhere, is as stable as a coin flipping back to its halving at the purple line. And naturally, people are in charge of it. When the US government finally closed its gold window in 1971, monetary policy went completely off the rails. Even though people have attempted to rein in the inflationary consequences, they go too far in both directions, and it has remained unruly ever since. We also feel they are going too far at the moment. Negative side. The actual Fed funds rate is this. The federal funds rate, therefore, is somewhere between 5.5 and 5.5%. As you can see, subtracting 3% brings us to 2.5% in that area. As things stand, markets don't anticipate a rate cut from the Fed until November, even if inflation drops as predicted. This line will extend closer to 5% if they do not make cuts when inflation falls. Once again, it hasn't happened since the 1980s, when inflation was seen to be deeply rooted or about to return to double digits. Today, we're not acting that way. On the following page, the amount of time between the Federal Reserve's last rate hike and its first rate decrease is shown on this slide, which indicates how long the Fed has maintained higher interest rates for longer. Now we're over average, as you can see. In addition, the previous three occurrences occurred when we were at a greater level than we are at now. Foreshadowed the worldwide financial collapse of 2008-09. We ended up with 0607. It foreshadowed the 8 in telecom. Crash of 1997 to 1998. Recessions in 1969 and 1970 were heralded by it. A little observation regarding budgetary policy. We reiterate that the solution to this deficit, which manifests itself in a so-called expansion, is at 6.5%, and you can observe the shortfall as we do so every time. It was only after the 2008 to 2009 financial crisis that it occurred. During the time that stimuli were still being freely processed by it, but right now we aren't in such a panic. And much as in the 90s, we think growth is going to be the answer. Thanks to the excellent growth, we ended ourselves back in a surplus in the 1990s, which was largely the result of the Clinton administration. The main points of today's crypto news have been covered. Insights, updates, and analysis regarding the cryptocurrency industry will be forthcoming. Feel free to leave a remark with your opinions. Please subscribe to our channel and give this video a thumbs up if you enjoyed it.